check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Thursday, second best day of the week. Getting ready to wrap it up already. Of course, Monday was a holiday for MLK Day, and then we had freezes for 2 days, and so now it's going to warm up today and they get cold again tomorrow. So, they said that it's impossible for temperatures to go from sub 20 to 70 in a day. Texas just said, hold my beer. So and then it's going to go back cold again. So there you go. Hey, climate change. In Texas, it changes every damn minute. There's an old saying, if you don't like the weather in Texas, just hang around a minute. So anyway, a couple of things. Of course, yesterday, markets not doing great. Of course, markets sold off most of yesterday, ended in the red. We'll talk about that here in a second. We'll go through some other sectors as well. But this morning, futures are basically flat again as we kind of continue to grind through this kind of consolidation we've been in. So far, it's been a pretty boring year, out of the gates. Not a lot of excitement. But again, things hopefully will get better. In 2 weeks, the blackout window for corporate buybacks will end. And of course, we talked about this in October, when the markets were selling off in October and we were heading down towards those lows. We were like, hey, October weakness, very likely, but that buyback window opens back up come November the 1st. And as soon as that buyback opened, then of course we had a record number of buybacks actually. For that period. Very strong amount of corporations buying back shares. Of course, that helped elevate the rally that we saw going into the year. So ever since that window closed, which was right here towards the end of December, markets really haven't done a whole lot. So we'll see what happens in 2 weeks when that window opens back up. But again, that's been one of the main buying powers behind the market. Almost 100% of net equity purchases over the course of the last couple of years have been solely attributed to buybacks, and it's just been a very large amount. But outside of that, also today, Michael Lebowitz joining. this morning. We're going to talk about the end of QT and the end of cutting rates, the start of cutting rates with the Fed. Of course, this has been the big topic here as of late. The market's expecting 6 rate cuts this year. That's much more than what the Fed says. According to the Federal Reserve projections, they're only talking about 3 rate cuts in their projections that they put out. Market's expecting double that. But also now we're talking about the end of QT, and why all of a sudden is all this going on? What is that fragility risk within the markets? We're writing about that in this newsletter this weekend on the website, realinvestmentadvice.com. But we'll talk about it some this morning as well with Michael. So again, stick around for that, and we'll get into that. Also, make sure that you have gotten by the website, realinvestmentadvice.com. Get the tickets for the upcoming economic summit on January the 27th. That's not this Saturday, but next Saturday. Greg Valliere will be here to talk about presidential election cycles, investing in markets. That link, that banner right at the top of the page. So just click that banner, buy your ticket, and we'd love to see you there. We'll spend some time. We'll have a panel. Adam Taggart will be there as well to moderate our panel. We'll take live Q&A, so we'll be able to talk about a lot of things while we're there. We'll feed you also, so it's always good. But anyway, tickets on the website now, realinvestmentadvice.com. Okay, here's what you need to know before the bell this morning. Let's go through a couple of interesting markets that are going on right now. So first of all, we'll just start with the S&P. Again, kind of interesting right now. Breadth has been good in the market so far. The number of stocks above their 15 200-day moving average still healthy, but declining. We're starting to see that breadth decline here a little bit. Markets took out the 20-day moving average yesterday. Again, that's not a hugely negative thing, but again, we did this before and then rallied back above it. We'll see if the markets can rally back above this and negate that break of the 20-day. If we don't, and the markets fail from here, then we're going to probably test this 50-day moving average around 40.60. So there's certainly some downside risk here in the markets. I don't want to negate that at all, but the underlying situation of the market is still fairly healthy. Optimism is still good. Positioning is still strong. Breadth is still decent. So again, there's not a lot of concern here that we're going to see a big contraction in the markets, but there's certainly always risk. And again, one thing that we can't kind of keep keeping an eye on here is the volatility index, which has picked up here over the last few days. We've seen a pickup in volatility. It's been a very compressed period that we've had, really starting back in November. As we had this kind of run up in volatility in October as the markets were selling off. Everybody was very concerned, like, oh, the bear market's back, and we were like, be careful with that. And then volatility basically collapsed into December. Volatility, and you take a look at what's going on with puts. There was no demand for put options. Those have also started picking up here lately as well. People are starting to put on a little bit of protection in portfolios against this kind of market action where we are. But we are seeing a pickup in volatility. Nothing alarming as of yet. But if we start to see volatility break above the 200-day moving average here and starting to really kind of pick up some steam, potentially we'll see a bigger downward move in the markets. But again, haven't seen any real sign of that just yet. Bitcoin continues to be interesting. After the whole launch of the Bitcoin ETFs a few days ago, of course, they all got approved, and finally the SEC and Gensler approved the issuance of Bitcoin. So we have spot Bitcoin ETFs, and so those got issued out. And ever since then, Bitcoin's just kind of sold off here. So not a lot of action. You would have thought that we would have seen a lot more buying activity because of those ETFs come in, but we really haven't seen that yet. And again, not enough data yet on these Bitcoin ETFs to really do any analysis, or I'd show you some charts. We need another month or so, and then we can start looking at how they're performing relative to the spot Bitcoin ETF. But jumping over to gold here also, as we take a look at that, gold continues just to really kind of grind here as well. Really hasn't done a whole lot, despite the fact that markets were all over the place last year, and we saw a good bit of inflationary pressures. Gold had a decent rally. We got down to about 1,800, rallied up to 2,000, but really kind of remains in this range. And gold has just been really kind of trending sideways here, beginning to did take out the 50-day moving average yesterday. And so we're going to kind of watch that here. Potentially the 200-day sitting around 1970-ish. So again, there is some downside risk to gold prices near term. We are in a sell signal, getting a little bit oversold here short term, but certainly some downside risk within this kind of topping pattern that we see going on in gold. Again, not overly concerning here just yet, but certainly kind of a corrective consolidative action at work in gold prices. And lastly, of course, we would be remiss not to talk about interest rates. Interest rates, moving back up here. We talked about this. Interest rates have gotten very, very oversold, or very overbought actually, on that decline. They're the inverse of bonds. So during that decline in rates, bonds got very overpriced, yields got very overbought. Seeing a bit of that reversal. It's not been dramatic. This has actually been a very healthy correction in interest rates. We're working through that sell signal. Again, it's inverted because of bond prices. This is a sell signal that normally looks like a buy signal, but that's a sell signal for bonds. Still working through that, working through that process. Interest rates getting oversold here. We're going to get a decent opportunity here, probably somewhere around the 50-day moving average, around 4.15, 4.19%. On the 10-year Treasury rate to start looking to add exposure to our bond portfolio as well. So we're getting there. This has been a very nice, healthy correctional process. So keep a watch on bonds here. We'll have a good opportunity there to add exposure as well. That's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz, and we're talking about the end of QT, rate cuts. What does it all mean? That's coming up on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Of course, it is Thursday. That means Michael Leibowitz joins us this morning. Of course, the big news, well, I shouldn't say the big news, but, well, I guess it's big news. It's kind of been the topic du jour as of late with a lot of people. But this is all about the Fed rate cuts. And now it looks like the end of QT might be near. This, of course, going on as the yield curve has started to un-invert on one kind of very kind of vague indicator. But again, when we take a look at the broad measure of all the yield curves, they haven't uninverted yet. So still in that process of inversion, which normally, of course, is, as we talk about, is pre-recessionary. You see this kind of pre-recession, but we haven't had a recession yet. Retail sales remain strong. We just saw strong retail sales numbers for December. That's going to bring in GDP in the fourth quarter above 2%, probably around 2.5% for GDP growth. So no sign of recession from the economic side. No real signs of credit strains. If you take a look at bond yields as a function of corporate bonds and particularly bond spreads, the spreads between different types of bonds, whether they're BBB or AAA, et cetera. No signs of stress within the credit markets. And yet we have the Fed now talking about cutting rates. And this is very interesting because in just 2 weeks, so on December the 1st, the federal Jerome Powell in the speech said, we're not even considering rate cuts. On December the 13th at the FOMC meeting, it's like, well, we're now talking about cutting rates, and that's coming into focus. So what happened in a 2-week period in the 1st of December that changed the attitude of the Federal Reserve when all the other indicators out there really don't suggest any real financial strain? That's the big question everybody's working with right now. What does the Fed know that we don't know? Or do they know anything? I guess is the other question. We'll see what happens. But Mike, welcome to the show this morning. Of course, happy Thursday. Kind of what's your initial takeaway here? Again, like I said, a very rapid change to the FOMC and Jerome Powell in just 2 weeks from, we're nowhere near the neutral rate to we're at the neutral rate, to take a line from 2018. But, we're seeing that same thing happen here. What's your initial take?
I think there's a liquidity problem that's slowly rising through the system. Like you said, the economy is doing well. Inflation is coming down, but it's still well above their target. So if you look at what their goals are, maximum employment and lower inflation, they have no right lowering rates right now, right? They still need to get inflation down, and they've been able to do it so far without really harming the labor markets. So what's going on? And, I think you shared this graph a week or two ago. I may have shared it. It's a graph of overnight Treasury repo versus Fed funds. And overnight Treasury repo is where people borrow, institutions borrow, and they use Treasury bonds as collateral for that loan. Fed funds are where banks lend money to each other without collateral overnight. Both are overnight loans. So if you just logically ask yourself, would I rather trade give money to a bank and hope to get it back the next day with no collateral, or do that with a bank or a money market fund or a hedge fund or another institution, but there's Treasury collateral supporting it? Which would I rather do? The answer would be with collateral. And accordingly, because of that, the collateral loan should always trade slightly less than Fed funds. Recently, that's been 10 to 20 basis points above Fed funds at times, not consistently, but at times. That's a sign that there's just not enough, believe it or not, I'm going to say this, treasuries in the market. There's not enough collateral in the market. That's what that is telling you. We saw that in 2018, 2019, and we're seeing it again today. So why is it happening now versus why didn't it happen 6 months ago, or why can't it happen a year from now? And that goes to the Fed. There was an incredible amount excess liquidity in the system. The Fed introduced or reintroduced this overnight repurchase program. It's another repo program, but this time banks and money market funds and hedge funds and all kinds of institutions are lending money to the Fed. So the Fed has taken that liquidity out of the market. There was way too much liquidity.
Right.
And the Fed does that so that they can keep the Fed funds rate and money market rates where they want it to be. If they didn't do it, those rates would be lower than where the Fed wanted them to be. So in their hawkish maneuvers to try to get inflation down, they introduced this program. The program got as big as, 2.4 trillion, just showing you how much extra liquidity was in the system. Well, now it's down to roughly 600 billion and dropping. There are some days it's dropping 34 billion a day, 30 to 40 billion a day. This program could be gone in 6 weeks, 4 weeks, whatever it's going to be. And the Fed is using that and the spread between what we talked about earlier, overnight repo versus Fed funds, as a signal, as a gauge that liquidity is running out quickly. So the Fed, I believe, because they could be getting a tap on the shoulder like we've talked about before from the president. Hey, I'm running. You better fix this. You better get rates lower. They could know something about the banking sector that we don't know. There are other explanations, but every day that goes by, I'm beginning to think more and more they're trying to get ahead of a liquidity problem. And I forgot who it was. One of them was quoted last week as saying that we don't fully appreciate how many reserves equal liquidity, how many reserves are really in the system and how many are needed. So we rely on markets to tell us that. What he's telling you there, or she, I forgot who said it, but what they're telling you there is that they're looking at that spread of overnight repo to Fed funds, and it should always be flat to negative, and it's not. So I think what's happened is that spread went positive, and that alerted the Fed that there's a potential liquidity problem, and it's probably March. Well, what else happens in March? That's when the bank term funding, BTFP, bank term funding program, expires. And the Fed has casually, not formally, but casually said that they're not going to extend it. So the banks will need to bolster their reserves, bolster their capital, potentially sell some assets going into that to help offset some of the demand, the deposits that they've been losing. So I think what we're really seeing is the Fed is trying to get ahead of a liquidity problem as opposed to falling behind it like they so often do. Mm-hmm. The problem they have, though, is that inflation isn't 2% or below. It's higher. So will they freak out the markets that they're starting to ease for all the not all the wrong reasons, but not the right reasons, and cause inflation expectations to rise, cause bond yields to rise, and start to really weigh on the economy. And that's what the Fed has. That's what the Fed is, I'm sure, weighing. They're discussing, and going, like you said, going back on their word. And it's a tricky box the Fed has built themselves, and I think it's going to be trickier to exit it because what a lot of retail investors don't realize is how much liquidity drives these markets, how much leverage there is, and how much in the overnight markets rely on this liquidity. So it's not just treasuries, it's stocks, it's bonds, it's commodities, it's everything.
So a lot to unpack in that. So first of all, that BTFP program, the Bank Term Funding Program, was put in place to bail out the regional banks back in March of 2023. And, it's interesting, the banks were using that funding program initially because their collateral values, because interest rates had gotten up to 5% on the 10-year Treasury, their collateral values had fallen so much that, we were having banks that were getting taken over by the FDIC. Now that rates have come down, it's eased that pressure on the collateral market. And now the banks are just using that program to game it because they can borrow from it and run that against their other borrowing rates and make the spread in between. They can arbitrage that program. So it's going to be interesting to see what happens if the Fed, I can see why the Fed would end the program. They're like, well, you're just gaming the system now to make money. You obviously don't need the program. You're just using it for arbitrage. So we'll end it, and it's going to be interesting to see what happens when they end the program if we don't happen to wind up right back into another collateral situation, particularly with yields back on the rise here. Again, yields have been coming up here a little bit. They gotten, as I said, the yields have gotten very overbought, so yields are coming down here a bit. But again, that rise in yields, even though a small amount, is putting pressure back on those of the collateral of those smaller regional banks. So it'll be interesting to see just at the time they end this program, if it doesn't cause another rash of, a couple of banks, having collateral issues.
Yeah, I think what's really important here to understand is how much leverage is in the system. And that is so important because that leverage needs liquidity. And some of that liquidity for leverage is simply in the overnight markets or in the 1 week markets, very, very short-term loans that allow someone with $10 of equity to own $40 worth of assets. And, every night they're rolling over, a couple dollars worth of loans, and it's all fine as long as they can roll that debt over day after day. But if there's not enough liquidity, they have to sell some of the asset to account for the fact that they just can't borrow enough or that borrowing rate is too expensive.
That's right. Yeah, and that's that's fractional reserve banking. That's how our whole system works, and it's all fine and dandy until something goes wrong with the leverage, and then you got all kinds of problems. All right, quick break. Come back. Step out one more step. So Fed rate cuts, they're coming. Right? Question is when. But now we're talking about the end of QT, this whole reduction in the balance sheet. After a massive expansion following the pandemic, now we're going to start increasing that balance sheet again. Really? Already? We'll talk about that as well. We'll come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny's always saying, I can't retire. You can't. Visual Capitalist put out a graph this morning. The title of the graph is, How Much Longer Do You Have to Live? It's a very sobering graph for 6 o'clock in the morning.
The Real Investment Show podcast.
You look at this graph and then you find your age. It says, I'm going to die roughly about 78. So I've got about 18 years left on my ticker. So I'm retiring soon.
At realinvestmentadvice.com.
The sand in my hourglass is running out.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell Report, Financial Fitness Friday, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
It's Thursday. Michael Leibowitz joining me this morning, talking a little bit about rate cuts and this really kind of change of attitude. And, you know, again, what Mike was talking about, we're going to finish up that conversation. He wants to add a little, something to that. But before we get there, I just want to take you back in time. This is very similar to what we saw in 2018. We've talked about this before. But remember back in 2018, September, Fed is hiking rates. We're nowhere near the neutral rate. Of course, at that point, the market's declining. We're down about 20%. President Trump's all over Jerome Powell. There's, conversations about, can the president fire the Federal Reserve chairman, this type of thing. And then in early December, Jerome Powell changes his mind. He says, we're actually closer to the neutral rate than we thought. And so we're fine. And then in July, they start cutting rates. And in September, they're doing this whole reverse repo bailout thing. And of course, we didn't know at the time what was going on, but certainly fragility to the system. And we're seeing a lot of that same evidence today. And that's the point that Mike was making, is that, there seems to be some cracks within the financial system that is worrying the Fed, something that they see that we don't have direct access to, but a concern, and a concern enough that the lack of liquidity could become more problematic very quickly in the months ahead if they don't start responding accordingly. So, Mike, you wanted to finish up that conversation.
Yeah, I actually wanted to tell a little story of my past. Long time ago, I was at Fannie Mae, and I was managing our short-term investing and funding desk. And every day we would come in and there would be a piece of paper on our chairs, and it was a summary of the company's cash flows. Of most important, it was a 30-day outlook, but of most important was that day. And every day, and I'm not kidding here, it would say, if all the payments and all the money that's coming in and out of the company come in and go out as expected, which is what happens, the company is going to be short X dollars. Sometimes that number was very minimal. Sometimes that number was 5 billion, 15 billion. It was over 20 billion. So you come in every day, and every once in a while there's a day where you're short 20 billion. If we didn't borrow 20 billion that day, Fannie Mae would not have been able to make good on some of their outgoing payments, i.e. default. Again, it's all kinds of payments. Some of it is due to investors, some of it is rent, wages, all kinds of things. But if we didn't raise 20 billion, 10 billion, whatever the number was, we would default. And that's because we had a portfolio of mortgages that was levered 40-1. So we funded a lot of it with longer term debt, but there's still a lot of rollover debt needed to make good. So I use that example because these numbers are staggering. The amount of debt in the system, the banking system is all 10 times, every bank is roughly 10 times levered. So not 40 times, but 10 times, and they are all using the overnight markets for funding. And if we were, at Fannie Mae, if it would have been lunchtime and I would have said, gone up to the CFO and said, there's no way we can raise the 20 billion today, they would have done everything possible, would have called JP Morgan, would have called the Federal Reserve, would have called whoever. But if that wasn't possible, there would have been a massive asset sale that day that would have been very consequential, not just for the mortgage-backed security market, but for every market, including, going all the way up to the dollar and, commodities.
Yeah. So,
and this is just one institution, right? There's a lot of these institutions. We were a very big one at the time, but one of many. So I just wanted to kind of share that personal experience to belabor the point of how important these overnight markets are. And if those markets are not healthy, the health of every other market is at risk.
Right. Well, again, this takes us kind of right into this whole other issue now of liquidity and lack of liquidity and what's been draining liquidity, and of course we have to go back to March of 2020. So in March 2020, obviously we shut down the economy because of the pandemic. We already knew there was stress going on. The Fed was doing this kind of reverse repo bailout in the background, had run about $1 trillion of that through the end of 2019, to supply liquidity to the market because there were fractures with that. And of course, in March of 2020, we shut down the economy. And in response to that, the Federal Reserve starts this massive quantitative easing program, $120 billion a month, along with buying high yield bond ETFs and a whole variety of other bailout programs all at the same time. Just literally trillions of dollars of liquidity being shoved into the market. Not to even mention what the government sending checks to households and a variety of other issues on top of that. But all in response to that, the Federal Reserve took their balance sheet from $4 trillion to $8 trillion, almost $9 trillion. In the course of a little bit over a year. And of course, starting in 2023, they said, okay, we're going to start unwinding that. And we've brought that down a little bit, but we're nowhere near back where we were pre-pandemic. And now we're talking about the potential that the Fed may have to stop QT and start increasing their balance sheet again, back to this whole issue of providing liquidity to the markets. And I guess the question becomes really twofold is this is another kind of, obviously a message that says there's some other problems going on within the markets, but also just how big can this balance sheet get and be? And is it just going to, and are we just going to have a 9, 10, $12 trillion balance sheet indefinitely in the future?
Well, here's kind of the answer. The answer is not really the Fed's balance sheet, but it's the balance sheet of every other institution out there. If you're going to continue to let those balance sheets grow, and by balance sheets, again, we're referring to leverage. If you're going to let them grow, the Fed's balance sheet has to grow with it. If it doesn't, they can't grow. There's not enough reserves in the system to allow them to grow. So if the Fed is not going to grow their balance sheet, the big banks and all these other institutions have to deleverage. They're going to have to sell assets. So, this is one of the reasons why assets have done a lot better than GDP, than the growth of the economy. That's the leverage component. So, if we're willing to be in an environment where a lot of assets, and, again, this isn't stocks, this is all kinds of assets, including real estate, get repriced to a lesser leverage environment, then that's how we get the Fed balance sheet down permanently.
Right.
It can go down for periods of time, but permanently.
Well,
so
and the other
that's
side of that,
the trade-off.
Well, and the other side of it is that with the spending binge that the U.S. government continues to be in, right? There's just a functional need that the Fed is going to have to monetize part of that debt issuance. Because again, to your point, we have a system that is highly leveraged. The banks, the financial system in its entirety, the real estate market, the mortgage market, the financial markets, all are running and the consumer is running a very, very high level of leverage relative to historical norms, which says that interest rates can't go up. A lot of people are talking about, interest rates are going to go to 7, 8, 9, 10%. Can't, because of all the leverage in the system. And particularly when we start talking about small cap and mid cap companies, the Russell 2000, massive debt wall coming next year. 24, 25, 26 is a massive debt wall that has to be refinanced for a vast majority of the small and mid cap companies that are out there. They can't refinance into a much higher interest rate environment. So, it's just a function that in order to keep interest rates at a level where the economy can actually operate and continue to operate, the Fed's going to have to monetize 30, 40% of that debt issuance when it comes out from the government.
Right. It really has no choice.
Right.
And, when you ask, what would I do if I was the Fed chair? It's very easy to say I would bring rates to 10% and kind of get this leverage out of the system. but getting this leverage out of the system is changing our lifestyles. You know, you're talking about a depression to bring asset values back to something more in line with the economy. And that's, I think, you know, every president, every Fed chairman, you know, a lot of congressmen, they run on these lofty, you know, especially the government, they run on lofty plans that I'm going to solve these problems. But when they're really told the truth, when they have that first day in office, fixing the problem is difficult. The best answer, especially for someone that's only going to be in a seat for 4 years or 8 years or whatever it may be, is to perpetuate the problem, not do it on my watch. And, you know, we see that with the Fed chairwoman. And it's awful, but that's what's going on, that the amount of leverage in the system almost by default has to increase if we were to continue to see growth in the economy and in financial asset valuations.
Right. And, you know, and look, at some point, does the shell game end, so to speak? And the answer is yes. And you're going to go through another 20-year period like we saw in early 2000s or in the 60s and the 70s or in the 30s and 40s, where you're going to have asset value, you know, stock prices basically go nowhere for a very extended period of time as you work through this overvaluation process. But again, you know, when that occurs, who knows? And what causes it? Who knows? Hopefully I just won't be around when that occurs. So we'll see. All right, quick break. We'll come back. We'll talk a little bit about that, actually. Valuations, markets, and kind of where we are now. We'll talk about that with Michael Lee. We'll come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Futures pointing higher. This morning they were a little bit flattish early, and then now looking a lot better. Nasdaq's up about 20 points. S&P's up about 20 points heading into the open. Nasdaq's up 100 and
42 points heading to the open, up almost 85 bips. Dow is down 20 bips. And so the interesting thing, and Mike and I have been discussing this here recently and talking about it, last year it was the run of the MAGA 7, the Magnificent 7. Sorry, slipped the tongue. But yeah, it was the Magnificent 7 that were driving the markets most of the year. And then in November and December, a lot of rebalancing going on. Funds were exceptionally long these, top 10 stocks. And as we got to the end of the year, they needed to rebalance and bring a lot of those other shares up to weight, which has been under a lot of pressure last year. So we saw a kind of this end of the year move where a lot of the laggards gained some traction. And so we said, hey, well, maybe this is going to be a new move as we move into 2024. We'll see a year where maybe the laggards outperform the leaders. And it seemed that way in the first couple of days of the year. NASDAQ sold off and we saw a lot of the laggards, still kind of doing well. And it turns out that a lot of that was just tax gain selling for the new year. And really ever since the first couple of days, it's been back to the Magnificent 7, the mega cap growth stocks have been outperforming small cap, mid cap, pretty much everything else in the markets. In fact, that brief spurt of activity in small and mid cap has completely reversed now. So it seems so far that we're kind of back into that same groove. And this morning, this market is going to be led up by Microsoft, Google, Amazon, those stocks again. So hasn't changed a whole lot. But valuations in all these companies, and particularly when you take a look at technology in particular, is at historically high levels. And particularly when you talk about these top 10 stocks, their valuations as a comparison to the rest of the 493 in the index or small cap, mid cap valuations are extremely expensive. And, but to Mike's point, and, this has been all a function of leverage. In fact, we've talked about this before. We've written articles on it. You look at the average rate of return for stocks from 1900 to 2008, averaged about 8% a year, which is what you would expect. Economic growth plus inflation is 8% a year with dividends. So you get about 8% a year. And that's about what you would expect from the market over time because it reflects the economic activity. And Mike made a good point. In the last segment, he said, well, stocks have gotten detached from the economy because of all this leverage. And he's right. Since 2008, when we started doing all of these QE programs and, Operation Twist and, government interventions and all kinds of stuff, the average rate of return from 2009 through 2023 has been about 12%. So we've added about a 4% annualized rate of return to stocks since the end of the last bear market in 2008. Question becomes sustainability, right? How much leverage does it take? It's kind of like, how many licks does it take to get to the center of a lollipop? But how much leverage does it take to maintain these types of returns and valuations going in the future? And is it sustainable considering the fact that the more leverage you have, the less economic growth you get? It's a very interesting conundrum that we face between the reality of debt and interest rates and what happens in the economy versus what the markets can generate. And so far, there's been a very clear detachment. The question becomes sustainability. Mike, this is going to be the thing that I think we're going to wrestle with, and most people in financial markets are going to wrestle with going forward, is this deviation between what markets should return and what they are returning.
Right. And it also helps explain the bulls and the bears and, longer term bulls and bears, why some people think the S&P is going to 50,000. You see these headlines every once in a while. Mm-hmm. Well, it's because they think that the leverage in the system will only increase. And over time, it's going to just keep going up and up and up because no one is really willing to pop that leverage bubble. And then you can see the other side of these, the depression type crew that are saying the opposite, that this is unsustainable. We can't keep borrowing this much money. At some point, something's got to happen to stop that leverage. And like I said, everyone's got to sell assets. So, understanding that as the fundamental driver really helps you understand in the longer term, not why the market's going to be up for the next 6 months or down, but helps you understand why the trajectory is probably higher. But if there's any interruptions to that leverage, and that can really set us back, set the markets back. So, that's what we're dealing with. We're dealing with a very precarious and when I say markets, again, it's all markets, including real estate. It's not just the stock market or just the Mag 7 or just, some subset of the market. It's everything. But, at the same time, the Fed is in control. There's believe it or not, a lot of trust and confidence in the Fed. The government can still borrow money very, very easily. Rates are a little bit higher, but it's not a problem. So, part of what we have to assume is that leverage will continue to do what leverage does, and it will support asset prices. It doesn't mean the market can't fall 20% this year because we go into a recession. But what it does try to help ensure is that the trajectory is generally higher over longer periods of time. So, this notion of what the Fed will do or what they won't do, it's not just, we got to get employment down, we got to get prices down. We have to manage this financial system and this leverage. And that's why we have to speak about the Fed so often, because at the end of the day, no one's ever going to say it. Their most important job is managing liquidity in the system. And liquidity drives these markets up and down. And that's why, Lance and I talk about the Fed all the time. If we were doing this show 20 years ago, we would talk about the Fed once in a while, but it wouldn't certainly be every day. And the daily, we would probably be talking about what Greenspan said at this meeting or that meeting, and that would be about it. We wouldn't know the names of most of the other Fed members or even know that they were speaking and saying stuff. But they hold the keys to the liquidity car, and that's what we're following.
Yeah, and I guess, and the big question obviously is like, okay, well, Mike, what causes, the end game here, which is what a lot of people are expecting at some point. And look, there's going to be a point that this leverage gets reversed, and what will cause that, we have no idea. We can go back and look at 2008 as a good example. Lots of leverage in the system in 2008. And then actually things were okay in 2008 until Lehman got forced into bankruptcy and everybody started questioning who they could trade with that might be in business tomorrow. That's the big question, right? And so, something like that will happen again, though. We'll get to the point to where we start, kind of throw caution. And we're seeing some of this stuff now. We're seeing this with the buy now, pay later, companies, et cetera. We start stretching out there. Oh, well, a little bit of credit risk is okay. Everything's fine there. So how about a little bit more credit risk? And, that worked okay. So how about a little bit more credit risk? And we'll start figuring out ways to game the system and leverage it even more and to generate higher rates of return, which the markets will demand. And then something will blow up. 1987, it was portfolio insurance. In 1999, it was faulty accounting. There's always that point to where the market gets a little too smart for itself and something blows up, and then we have to kind of work through that process. We don't see that right now. We don't have the subprime loans at the moment. So when people talk about, we're gonna have this financial crisis again, not right now. We have a lot of debt, but we don't have a lot of those risky loans that were out there. But they're going to come back. It's just a function of kind of when they come back and kind of what form they take. We saw a brief moment with SPACs, and those have ended badly, of course, as we knew they would. But those are the things that Mike and I are looking for as we go further and go out in the future. There's just so much leverage in the system. When something finally breaks, it will cause a problem. And and Mike, it's been interesting because you would have thought mortgage rates at 7% would have really negatively impacted the housing market, but it really didn't. We saw housing prices come down somewhat, but we didn't see. A lot of people were expecting a big crash in the housing market. Maybe that's still yet to come, but rates are coming down. Home builder confidence is improving. People are anxious to try to buy a house now with lower rates. So again, there doesn't seem to be much out there at the moment. Credit risk spreads are very low. Doesn't seem to be, a lot of risk in the credit markets currently, despite the amount of leverage that's out there. But it doesn't mean it's not going to show up at some point.
Yeah, it definitely will. And I think what matters is trust and confidence in the Fed, right? In 2008, it was the Fed that ultimately stopped the banking dominoes from falling. And so, I think as much as we may not want to see it because it's not good for us in the longer run, the Fed being proactive with cutting rates and potentially tapering QT is what these asset markets want to see. They want to know that the Fed will not let this system get down to the point where we have a liquidity crisis. And that's why the markets have been doing very well, both bond and stock markets. And as long as the Fed kind of does this very market-friendly walk, I think it's in good hands. And keep in mind, when they were raising rates aggressively, that was also market-friendly.
Yep. All right, that wraps up the show for the day. Of course, as always, you get by the website, realinvestmentadvice.com. Click on the link to get your tickets to the upcoming Economic Summit. Mike's going to be there to talk about the bond market, the Fed, all that, and you can ask him questions live while you're there at the event. So click in, get your tickets now. It's not this Saturday, but next Saturday, January 27th. We'll see you there. Click the banner, get your tickets. Have a great day.